She is one of the finest finance writers in our country, with her books being perennial bestsellers. Monika Halan, author of Let's Talk Money and Let's Talk Mutual Funds, joins us for a masterclass on financial management. Tune in to hear all your questions about personal wealth management, investments, and more answered in this truly insightful session.
Hi, I'm Monika Halan. I'm the author of Let's Talk Money and Let's Talk Mutual Funds. And on this very special World Book Day, I'm here to bring you a masterclass on money. So let's begin. The first thing that I want to talk to you about is to say that we Indians have a very difficult relationship with money. We think that the rich people are evil and corrupt, and we think that being poor is to take a morally high ground. The poor stand on a high moral ground, and the rich are morally weak, evil, and corrupt. I think we need to go back into the history of India to see where this attitude comes from. I call it a poverty mindset. It comes from being generationally poor. So we know that India at some point used to be a very rich country in the ancient past, and then the invasions happened, and slowly the country lost its wealth. At the time of independence, we were so poor that impoverished, bad in health, bad in everything, that an average Indian lived to the ripe old age of only 32. We should know that that number today is at 72. So, for generations, if a people know that they can never get rich, they know that wealth is not part of their life or their children's life or any time down in the future, then the only way to stay sane is to put poverty on a high moral ground, to say that at least we have our value system, at least we are morally noble. And look at the rich, they're all corrupt, they are smugglers, um, they're filled with all the bad habits that we look down upon. So that sort of became the way to stay alive. And I have no, there is no comment on why this happened or on this attitude itself, because it kept the generations going one after the other. But so much has changed, and especially after the 1991 economic reform, India has taken a completely different growth trajectory. And I call most of you who are listening to this and watching this, you've been born after the year 2000. And I call you the abundance minded generation. We are the poverty minded generation. We grew up in a socialist country where there was really nothing. But most of you have been born in a country which with a very different economic philosophy where profit is not a bad word and where aspiring to be rich is good. But there is still this moral problem with stating this clearly, that I want to be rich. It is such a statement that it makes people very uncomfortable. I have noticed that if somebody were to say what is the goal in your life, and someone were to say I want to be rich, there is usually a judgment passed down on that person. And I want to tell you that it is fantastic to be rich. All of us should be. I am not talking of being a multi-billionaire, but just having enough, being well off to afford the kind of things that you want to. I find that what is coming in the way of this new abundance mindset and this journey to being rich is the attitudes to money and the way that we look after our money. The way that we look after our money is a lot of people are still stuck in money attitudes of the past, of 70s, real estate, gold, insurance products. Whereas there's a whole new way, new financial products, new way to target long-term wealth creation. Not for a moment am I saying, I will get you rich tomorrow. That is snake oil. I don't sell that. All that I'm telling you is that a structured, fundamental driven plan for your finances has the power to get you rich over your working lifetime. It doesn't happen in a year, it doesn't happen in 3 years. So I will begin by telling you that We need to think of our money lives like a dhan chakra. Dhan chakra is the circle of wealth of our lives. So all of us, we earn incomes, whether we earn it like a salary every month or we get periodic bursts of income as a gig worker, but something drops into our money box every month, right? And this money gets spent. We spend it on living costs, rents, EMI, to pay taxes, insurance premiums, all of the costs of living. And then something is left over, and we call it savings. Income minus expenditure is savings. This is not a rocket science equation, is it? But this is the point from which you begin to take control in your hands. Are your savings a residue or are they a target? Think about that. Write it down right now as you're watching this. Ask yourself this question. Are my savings what is left over, a residue, or do I have a savings target in my mind? That is the beginning of control of your financial future. Okay, so let's say that you have a target and there is some amount of saving. But savings do you no good because they don't earn any return. Savings is cash. Mostly in a savings deposit, you're getting 3.5%. With inflation at 5, you're losing purchasing power. So you need to turn savings into investments. And that's where we all freeze because the landscape is so complicated. There are so many products, there are so many choices that we really freeze in this crucial decision of turning savings into investments. Now, I will give you a way to think about this. There are only three ways fundamentally to convert your savings into investments. And that is through the route of different asset classes. Don't get afraid when you start hearing these jargon words. What is an asset class? I will talk about three of them. There's debt, there is equity, and there are real assets. When we talk about debt, we will think about things like fixed deposits, public provident fund, bonds, debt mutual funds. This is the safe part of your portfolio. This is the predictable part of your portfolio. To take too much risk with this. So debt in your brain should trigger the thoughts of safety, predictability, and liquidity. You need the money. When you need the money, it should be there. So even a fixed deposit, for example, is liquid because all that you lose if you tap into it a little earlier is 0.5 percentage point of interest, isn't it? So that's one way to convert your savings to investment is through the route of debt products. So, but debt products don't give you very high returns. They might give you just returns which keep pace with inflation, but once you apply the axe of tax, they might go under, right? So debt is not known for the debt part of the asset class is not known for high returns. So you come to the second one, which is equity, which we all know is stocks and shares. This is either ownership of your own business or somebody else's business. When you invest in somebody else's business through the stock market, you become a risk taker and also a participant in the profits through dividends and increase in stock prices. You know why people do startups. It is their chance of getting rich, of taking their company, making it big, and growing their wealth. The root of equity is to be used to do long-term wealth creation as you take the risk of business, either through your own or in participation of somebody else's business. So equity should trigger the thoughts of long-term high return, long-term high return. And then there is the asset class called real assets, which are physically present, which is land and which is real estate and gold. Gold, we know, is a great inflation hedge. It has a place in the portfolio of about 5 to 10% of your assets stay in gold through the sovereign gold bond scheme, which is the Government of India assured scheme, a guaranteed scheme. And real assets is something that we Indians are very familiar with, but it is not an asset class which is a sure shot thing. Over the long term, the returns that it gives is slightly less than equity. All right. So when you look at the long-term average rates of return, real estate average returns are lower than equity. Plus, there is a whole lot of problem with the problem of needing black money to buy it, the problem of it being a clunky asset, it's not liquid. And also the problem with real estate is when you look at the income out of it. What is the income? The annual rent. When you divide that by the capital value, the yield on your real estate asset is only about 1.5 to 2.5%. It is that low. Remember, PPF is giving you 7.1% tax-free today. So every time you think of a product, think of it in terms of risk and return. And think of it in terms of income that you're deriving from it and the profit that you potentially might make. All right, so we have to choose between, and it's not an either or. A portfolio will have some amount of debt, a lot of equity, some parts of it are real assets. So it's like a thali meal with little bits of different asset classes. So we convert our savings into investment by passing them through different asset classes. These asset classes release a stream of both income and profit. What is income out of these? Rent, interest, dividend, rent from real estate, dividend from stocks, interest from fixed deposits, bonds, and then profits. Profits on gold, profits on land, profits on stocks. So a mixture of these becomes income into your money box. Remember, we started with income, which you earn through the use of your labor. When you do some work, you're using your labor to generate an income. That income is spent. Some of it is saved. That savings becomes investment. This investment releases a stream of income and profits, which becomes income in your money box without you having to have spent your labor. This is called passive income. It's income which you have earned without doing any further work. You haven't gone into work to earn this income. And the goal of financial planning, the goal of an average person is to collect those many assets so that you can continue to fill your money box with income now and forever till the time that you're alive without going into work. And typically this moment comes around the age of 55 to 65. Different people, different numbers of their age, but the goal is to collect that amount of money so that at the time when this factor of production, labor, is either too old or tired or sick or simply bored or outskilled, if the AI has come and taken your job, in any of these situations, if you don't want to or can't go to work, what does your money box fill? Because see, the need for money doesn't go away, right? So we need money till the last breath. After that, it doesn't matter. But till that last breath, we do need that money. So when I talk about Dhan Chakra, you should think of your entire life as this play of money moving from one box to the other, with the goal that the asset box is so large that by the time that either you can't go to work or choose not to, you have enough assets to last you for your lifetime. And I would try and target an age of 100, because Indians, especially in the urban areas, are living longer and longer. So target a large enough corpus. Now, approximately what is this number that should be there in your retirement box? These numbers are a little scary, but let's just go through them. Now, what I want you to do is, there are a lot of calculators, and SEBI's website, investor.sebi.gov.in, has some very interesting calculators in that. I advise you to go and just check them out. You should see what you are spending every year today. Extrapolate it using 5% annual inflation to see what is it that you will spend when you're 60 years old. You will get there, I promise you. You think you are 25 and you'll never get to 60, you will get there. That's a promise. Inflate your expenses today. See, all of you may be at very different ages and stages. So I can't give you one number, right? and your expenses will also vary. So you use an inflation calculator, use an inflation number of 5% per year, and see what is it that you will be spending annually when you hit age 60. Okay? Whatever that number is, multiply that by 26. There's a certain logic to 26. This is basically you are eating into half of your capital and half you're leaving for your heirs. But so the numbers are budgeting that you live till age 100, and at that age, half of your capital is still left for bequeathing. You have eaten only half of your capital. If you were to eat all of your capital, then you would only need 18 times of your annual spend at 60. And if you wanted to bequeath your entire money to your children, then you would need 35 times of your annual expense at age 60. I have taken a midway, halfway house of 26 times. So what are we doing? We are saying, I'm projecting my expenses today, because finally it's not about income, right? You can be at a very different point of income, but it is really your spending that you need to protect in the future. So your annual spend at age 60, you multiply that by 26. And that is the number that you need as your retirement corpus. And if you're doing the maths right now, I'm sure you're looking at some very large numbers, 6 crore, 8 crore, 10 crore, depending on what your expenses are, 15 crore. And it looks almost impossible to get there, isn't it? And here is where the asset class discussion is of great importance. So I want to do a mind experiment with you. Okay, I want you to see the consequences of choosing different asset class for your long-term retirement goal. So let's say there's a person in the year 1990, and she put 1 lakh rupees each in 4 different products. Okay, she chose a fixed deposit, put 1 lakh into that. She bought gold for 1 lakh. She invested into the Public Provident Fund, PPF, and she bought an index mutual fund on the Sensex. Now, if there are things that you don't understand, like index fund or Sensex, Google is your friend. Just there's enough material out there for you to understand basics of these products. So she's done these 4 things, and then she does nothing, waits for 30 years. And around comes 2023. And what does she have now? Fixed deposit has grown to about 16 lakh. 1 lakh has become 16 lakh over that period. Gold has become 19 lakh. And the Public Provident Fund has become 19.2 lakh. The 1 lakh that she bought an index fund on the Sensex is now worth 64 lakh. That is the difference between safe investing through a debt product like fixed deposit, PPF, through a product like gold, and allowing money to ride a broad market index over a long term. So the growth rates are between 9 and 9.2% in the first 3 that I've mentioned. And the Sensex return from 1990 is at 12%. The difference between 9% per year and 12% per year is the difference of several tens of lakhs between 19 lakh and 64 lakh. So my message to you is that for your long-term retirement goal, especially if you're in your 20s and 30s, you must take the equity route towards investing. But then you say that equity is dangerous, it's volatile, it goes up and down, and that is all true. So let's take the story of India's unluckiest investor. What are we trying to see? We are trying to see how risky is equity, because, newspaper headlines say so many lakh crore of investor money wiped out. So much money has been lost overnight as the markets have crashed, etc., etc. But again, let's look at it. Let's look at it over the very long term. So there is again this person who's investing 1 lakh rupees every year, but he's investing at the top of the market every year. Okay, so he's India's unluckiest investor. Every year when the stock market hits a 52-week high, so there is one day in the year when the stock market is at its highest, right? So it will be lower before and after. There's one day in every year. For that year, the stock market has a very high value. There'll be, of course, be a value which is the lowest, but we are looking at the unluckiest investor. This person has invested 1 lakh rupees every year for 30 years. And every year he invested at the highest point of the market. The markets fell thereafter that year. Of course, next year they may have risen again. But in that year, they fell after he invests. Because a lot of people feel that, they are unlucky and they invest and the market falls. So let's say this person is unlucky for 30 years. So he has invested 30 lakh over 30 years. What do you think the value of his holding is after 30 years in an index fund on the Sensex? The amount is 2.3 crore. Okay, India's unluckiest investor, simply doing index investing on the Sensex, you can choose Nifty 50 if you like, Google them, is sitting on 2.3 crore over 30 years. You think 30 years is a long time, but you know what? They happen very quickly. They go by. So we are talking about how to think about equity over the long term. But you're saying, what about my today? What if I need the money today? So you need to invest in the equity market by following some rules. Okay, these are very important. Don't get into it if you don't follow these rules. And these rules are to seatbelt your persona today, who you are, your financial situation. You put seatbelts around yourself today to secure your current financial stability, and then you can take the risk long term of the stock market. And how should we think about that? You have to do several things. The first is that you need a cash flow system in your life. That's your first seatbelt. What is a cash flow system? You've heard about that for companies, but you know what? It works for us as individuals as well. Basically, what you're trying to do is you're trying to separate your savings from your spending. If you have a clear oversight over your spending and your saving, and you don't mix the two, your segregated savings have the power to become investments over time. All that we want to do as the first step is to segregate them, and that we do through a 3 bank account system. So you open 3 bank accounts, most of us already have them. Now it's just the work of labeling them. Okay, we use labels. Your first account is your income account. Every rupee in your life, whether it's income, bonus, commission, whatever comes into your life, gifts, they all drop into one bank account, XYZ account, whatever it is, your salary account. You label it in your head as income account. Every month, top of the month, you move the money that you will spend that month to a second account, and you call it my spend it account. All of your spending, living costs, EMI, rent, premium, whatever, happens through this account. You don't spend a rupee out of any other account. And the money which is left in the income account, there has to be something left. You can't be spending all your money. Goes into the third account, and you call it my invest it account. This is where we are beginning to gather our savings to start investing. And remember, I said that savings is a residue or a target. Here is where you can operationalize that concept. Are you going to credit your invested account before you credit your spend it account? Or will you take all the money you need to spend and whatever is left you put into the invested account? This decision of first crediting your invested account and then spending the rest is one of the most powerful tools in your financial life. It puts the decision of how much you want to save firmly into your hands. It's not an ad hoc. It is not something which is thoughtless. It is very thoughtful. So that's your first seatbelt. Just by doing this, you put immense financial control into your hands. The second seatbelt is to create what I call an emergency fund. The money which is beginning to accumulate in the invested account, we don't use it for long-term equity, derivatives, nothing. We put it usually into a fixed deposit. and create a fund which is of use to you should you lose your job, should there be a medical emergency, should there be something in the family, something might happen where you need money quickly. How much do you need? About 6 times your monthly expenses. How do you know your monthly expenses? What the amount that you're putting into your spend it account. You've got a handle on that. Times 6 is the amount that you need to target in your first financial product, which is an emergency fund. There is no shame in using fixed deposits. You can, of course, if you know mutual funds and you can do liquid funds or money market funds, absolutely use them. But for money which is there for use in an emergency, it should be predictable, it should be liquid, it should be safe. All of these attributes are there in a fixed deposit. So I wouldn't worry about return for my emergency fund. I would worry about safety, liquidity, predictability. Okay, return always is not the biggest thing. Huh? Counterintuitively, return is not your biggest attribute in many investments. Safety might be, predictability and liquidity might be. Imagine if you had a real estate 2 BHK as your emergency fund and you needed money. You can't sell one kitchen, right? You have to sell the whole thing. It takes time. So learn to match products with their use. So that's your second seatbelt. You're creating a cushion that there is money which you can use in case something goes wrong, so that the money which is apportioned for your long-term use is not touched. You are trying to keep money in the product, in the stock market long-term. Therefore, you're creating these pools of money, emergency fund. And the third seatbelt is to buy insurances, both life and medical. Everyone doesn't need a life insurance policy. Only people who are the principal breadwinners, who have a family to support, they need a term life cover. What is the product to buy? Not a ULIP, not a money back, not a whole life, not an endowment. Those are toxic products which are harmful for your financial life. If you're buying insurance to protect your family, you need 10 times of your annual income, at least 10 times of your annual income. So if you're doing just 10 lakhs a year, your insurance cover is 1 crore. The only product which is affordable and useful is something called a term life cover. Buy it online, fill the form yourself, get a medical test done. You don't want your beneficiaries to get a claim rejection because you didn't fill the form yourself and the information was incorrect. So your insurances have to be in place so that in case something happens to you midway, the family has a very large amount of money coming their way. And medical insurance, because look, what are we really afraid of? Not really of dying, but more of going to the hospital because of the bills. So a medical insurance will allow you not to dip into your savings, but have that cover so that the hospital bill can be filled. Of course, there are times when the cashless doesn't work. Your emergency fund might come in useful there, but you will replenish it once your insurance claim is processed. So we are putting in seatbelts to secure us today so that we can take the risk that the equity market brings to us. So once this is done, we've sort of protected ourselves and we are ready for investing. Your next question is, how do you begin? You split your goals into short, medium, and long term. Now you're ready to begin investing. We are still not doing long-term investing. We are saying there are things you might need to do within the next 3 years. There are things like you might need to do between 3 to 7 years. And then beyond 7 years is what we call long-term. The shorter the goal duration, the lesser the equity in it. So for short-term goals, there is zero equity. For goals which are 3 years away, 3 years or less, you stay with safety, predictability, liquidity. What are the products? Fixed deposits, debt mutual funds. Not even the public. So you start typically 1/3, 1/3, 1/3 is how we apportion our money between short, medium, and long term. Of course, at different stages, somebody might be putting half their money for their long-term goals and just a quarter each for short and mid-term goals. These are very personal decisions. But It is perfectly okay to have a quarter of your savings invested for short, a quarter for medium term, and a big chunk, which is half for your long-term goals. So short-term goals, zero equity, medium-term goals, some equity can begin. And for your long-term goals, you're 100% into equity. Okay? So something which is 7 to 10 years, typically it is retirement. You are fully into equity. And within equity, your question is, what do you buy? This is not, I am not telling you to do day trading. I am not telling you to do futures and options. Do you know that 9 out of 10 people lose money in F&O? 7 out of 10 people lose money in day trading. Did you know this data? So this is speculation. This is gambling. Do it as you would buy a lottery ticket, but investing is very boring and serious. So how do you begin? You begin not even with direct stocks because the risk is very high. No IPOs, no direct stocks. You begin with mutual funds because it diversifies your risk, it reduces it. The money is used by experts to do stock picking if you do active funds, but your first fund is a passive fund. What is a passive fund? An index fund. A fund which mimics an index. What kind of an index? Typically the Sensex or the Nifty 50 are the first indices you begin to invest into. The advantage of index fund is that you don't have what is called fund manager risk. So what is the problem with the mutual fund? Equity fund where fund manager is choosing stock, her choice might go wrong. She might misjudge the market. Your returns might be lower than the benchmark. Index fund takes away that risk and you grow at an average rate that the market grows at. Your question is, how do we know that the markets will grow? It's a good question. Countries like Japan tell us that you can have a 30-year period in which there's no growth. Okay, so it is possible that countries slump into recession, depression, all kinds of things can happen. But looking at the Indian growth path trajectory, we've had 10 years of solid reforms on the back of the reforms of 1991. So 91 reforms happened. And then the last 10 years, we've had the GST, we've had the bankruptcy code, you've had Jan Dhan, you've had the digital revolution, you've had the twin balance sheets problem has got sorted, our foreign exchanges are in good place. So we've got a very good mix of macro stability along with micro reform on the ground. The projections are that we should be growing at around 7%. And how do you predict the market? You typically take real growth plus inflation. So if you're doing 7 of growth and 5 of inflation, you're already at 12. And then, of course, there's an equity premium. It should be projected that we should be doing between 12 to 14% year on year for the next decade. That's how you project an index into the future. These calculations will be very different for many other countries. We are talking of the India story, we are talking of the India growth story, and we are talking of using this growth in the market to secure your long-term future. Because remember what we started with, this whole circle of wealth, Dhan Chakra. You're trying to get your money to work harder than actually what you do. So you work very hard for your money. You want your money that you're saving to work harder than that, so that by the time you want to stop working, your pool of investments is so large that you can sit home, read a book, listen to some music, go for a walk, and your passive income gets you the money that you need every month for the rest of your life. So I want to leave you all with one last thought. On this journey, on this money journey, sometimes some people get obsessive about money. What you need to remember is that you should have the money should not have you. I wish you all a very rich money journey.